Are you investing or chasing dopamine? Analysis from neuroscience, behavioral finance, and modern market psychology. You pick up your phone. You look at the chart. The price is moving. Your heart races slightly. A small rise satisfaction. A sudden drop tension. A new opportunity excitement. The question is, are you really investing or are you chasing dopamine? 1. What is dopamine and why is it so powerful? Dopamine is not the happiness hormone. A more accurate definition. Dopamine equals the chemical of anticipation and seeking. One of the leading figures in this field is Kent Berridge. Berridge's research shows that dopamine produces desire more than pleasure. The anticipation of the reward, rather than the reward itself, triggers dopamine release. In other words, it's not the price increase but the thought that it might increase that triggers the chemical. 2. Why markets are dopamine machines? Financial markets contain three powerful addictive elements. Variable reward. Not every trade yields a profit. But sometimes a big profit comes. This uncertainty system is the strongest form of reinforcement. This mechanism was first demonstrated in B.F. Skinner's experiments. Uncertain reward, stronger repeat behavior. Instant feedback. Charts change in seconds. Every movement is a small stimulus. Potential big profit. The possibility of a big profit suppresses the brain's risk center. Result: the market can resemble a legal gambling table of the modern age. 3. The difference between investing and dopamine. Real investing is planned, is boring, requires patience, involves little action. Dopamine chasing produces frequent trading, constant chart checking, news addiction, impulsive decisions. Real investing is boring. Dopamine craves excitement. 4. Overtrading and performance. Research in the field of behavioral finance. For example, the work of Terence O'Dean shows that investors who trade more frequently achieve, on average, lower net returns. Why? Trading costs, emotional decisions, overconfidence. But the person feels, I'm active, I'm in control. This isn't control, it's a cycle of arousal. 5. FOMO and social dopamine. In the age of social media, sharing other people's earnings, news like, this stock is soaring, crypto explosions, produce comparison and fear of missing out in the brain. FOMO, fear of missing out, is fueled by dopamine. Trading is done to avoid missing out. Excitement, not strategy, drives things. 6. Signs of the dopamine cycle. Beware of these behaviors. Checking charts multiple times a day. Impulsive, unplanned trades. Excessive pleasure from small gains. Intense stress from small losses. Restlessness when inactive. This isn't an investment reflex. It's a craving for stimulation. 7. Why is it dangerous? Dopamine-focused investing distorts risk perception, increases impatience, can reduce long-term returns, drains mental energy. Most importantly, puts emotion, not strategy, at the center. The deep truth. Market movement is often random in the short term. But the brain wants to assign meaning to every movement. This effort to create meaning creates a narrative, creates trust, creates trades. But not every trade is an investment. Ask yourself, do I feel restless if I don't trade? Is this position planned, or is it driven by excitement? Is my trading frequency aligned with my strategy? If the answers aren't clear, dopamine might be at the helm. Conclusion. Investing is a long-term game of discipline. Dopamine is a short-term game of arousal. When both are pursued simultaneously, this usually happens. Excitement wins, returns lose. The real question is, are you actually building wealth? Or are you seeking arousal?